All right, it is 6 o'clock, so I think we will get started here. I want to thank you all for joining us. Start out by saying I sure wish that we were in person at Jerry's again, enjoying an excellent meal and meeting in person, but not in the cards this year, but looks like it will be next year. So this should be temporary and get back to normal real soon here. So like I said, thank you all for joining us. Going to go through a quick crop insurance update here and then also an update on farm programs. I'll go through the crop insurance stuff first and then get into the farm program stuff. So as we go along, if you do have any questions, if you're on a computer down at the bottom, you can click, there should be a question and answer section you can click on and type in a question. If you'd rather ask your question verbally, you can, I think in the chat section, you can raise your hand and I can set it to where you can speak and you can ask any questions you might have. So don't hesitate to do that, even though it's a little different than being in person, but questions can still be valuable. You might not be the only one that's thinking about it. So we'll get going here, hopefully. There we go. So first off, just a reminder on plant dates. So none of this has changed from last year, but I just want to give a quick update. Initial plant dates on corn. So pretty much Buchanan, Atchison, and Jackson in the north is going to be April 5th. And to the south, that is April 1st for the initial plant date. And just as a reminder, what that initial plant date means is that if you plant prior to that date, you do not have replant coverage. You have your other coverage in place, but if you plant before that date and you have to replant, that is not covered. Final plant dates, pretty much for anybody that's on this meeting right now, would be May 25th for corn. Final plant date. After that time, you start to lose some coverage. On soybeans, initial plant dates, pretty much on the Kansas side, we're looking at April 26th. And then over on the Missouri side, April 20th. So again, that's a date that if you plant before that, you do not have replant coverage. And then final plant dates on beans on the Kansas side, June 15th, and on the Missouri side, June the 20th. Base prices for this year. So right now we're looking at about a $4.58 projected base price for corn. That is in comparison to $3.88 last year, so pretty significantly higher base price. Beans, even more significant, looking at an $11.83 base price for 2021 compared to $9.17 last year. So those two things alone there are going to give us significantly more coverage on our corn and soybeans this coming year, which, as a reminder, does mean increased premium, but only the same percentage that you gain the coverage from the extra price. Now, the other thing is that volatility factors, so along with setting a price during February, they also determine a volatility factor. And that is meant to give some measurement of how volatile the markets are. Obviously, they're a little more volatile now than what we've seen in the recent past. And so right now, our volatility factors are projecting to be higher than they have been in about 10 years. Downside of that is that also adds to premium, but doesn't add directly in dollars of coverage. So, I don't think there's going to be something dramatic, but it will come into play more than it has in quite a few years for us. So, but again, none of this will be final until the end of February, but we're getting awful close to that. So these numbers should be pretty much in the ballpark of where we're going to end up. Another reminder about timely notices of loss. So it's very important that you notify us immediately if you think you have a claim. For replants, that means before you destroy the first planting. I always try to encourage people, even when you first suspect that you might need to replant something, call us and let us know. We'll get it turned in and get you in touch with an adjuster. Then you can handle it with them moving forward, as opposed to, calling up and saying, hey, I'm going to the field this afternoon. And if we get it turned in and you end up not replanting it, it's not that big of a deal to withdraw that claim. So let us know as soon as possible. On preventive planting claims, if you don't have all your crop planted that you intended to by the final plant date, get in touch with us immediately. Let us know that, and we'll kind of walk through the options. And then on production losses, so yield losses, as soon as possible after harvest is complete is when we need to know that. So anytime you finish a farm or something that you think could even be close to a loss, don't hesitate to reach out to your agent. Let us know how many bushels you harvested or what the yield was. And we can look into that and see if it's close to a claim, see if it's something we need to turn in. So doesn't ever hurt to let us know and keep us updated what's going on. And the reality is RMA's gotten a lot more strict with companies on this issue. used to have a lot of flexibility in terms of claims that were turned in late, but we just don't have that anymore. And so, we get out here in January or February and find production losses from last year, and we have no ability to get those paid. So keep that in mind and just let us know as soon as you can on claims. Timely paid premiums. So a reminder that when you're paying your premiums, in terms of whether or not you're going to get charged interest, what it comes down to is when the payment that you send in gets postmarked. That's the date that is going to matter. If you have any 2020 premiums that are still unpaid, make sure we get those paid by March 15th, or the policy will be terminated for 2021. Accurate yield reporting. So new rules also have more strict penalties for misreporting production if this gets found during a review. Reviews can be triggered randomly. So, every year they pull a certain number of policies and do a random review, or with large claims can also trigger a review where you have to turn in evidence to support the yield history that you've turned in on your policy. Those usually start by doing the most recent year, and then if there's problems, having to go back further years. If APH yields are inaccurate past a certain threshold, you could have yields imposed for that entire crop year now. So that's a pretty stiff penalty in a lot of cases. That could just be due to an innocent mistake or a slight miscalculation. So some tips to try to avoid this. First off, and I think probably the biggest one, and especially looking back at 2020, this was certainly an issue, is to adjust loads for high moisture. So we had been working with tickets here the last few months, and we had a lot of corn that was harvested out of the field and taken to town well above 15% moisture. So need to make sure we get those adjusted correctly. And then the other thing would be updating submitted yields after you've emptied out on-farm storage. So say you put corn in a bin and we estimated that there was 20,000 bushel in there. We turned that in, and then you get it all hauled out tomorrow and realize that you only hauled 18,000 bushel out of it. Call us, let us know. We can look back and make the adjustments we need to and get that corrected so that if there's ever a review, we don't run into this problem. And then another thing I would add too is if you're going to feed production, especially a significant amount of production, it's probably best to just have an adjuster come out and measure those bins after harvest when you have them full. That way we don't have to keep feeding records or anything like that. We've got the adjuster measurements to go back to, and that's really about the simplest way to handle that. The other thing is, and many of you are familiar with this, but you can use our production record booklet, or we can use the production record booklet to help document and verify these APH yields that we turn in. It's also set up to make moisture adjustments and things like that. So if that's something we can help you out with, please let us know. Okay, so now getting into actual new issues for 2021. The first one I'm going to talk about is a quality loss adjustment. It's a new option. It's going to allow you to use your yield before quality adjustments were made to calculate future coverage. Examples of quality loss would be like grading, test weight, defects, odor. Probably the one we run into most is these injurious substances, aflatoxin, things like that. Probably what we deal with most around here that would come into play here. And just kind of to explain this, well, I have an example on the next slide. I'll just wait for that. There is an increased premium for this option if it ends up actually increasing your coverage. If it doesn't come into effect, then there's no cost. If it does come into effect, it's just going to increase based on how much coverage it actually gained you. We generally are recommending adding this as the extra coverage is almost always worth the extra premium. And that's similar to trend adjustment and yield exclusion in the past. This is going to be rated very similarly. So what we found in looking at those numbers historically is that yes, there'll be some extra premium. When you look at the coverage you gain, it's almost always really cheap extra coverage. Just an example of what this might look like then. So let's say you go out and you harvested corn that yields 100 bushel per acre by weight, but there was a loss filed and there was aflatoxin present when you took it to the elevator. They sent it off for state grade, did all that stuff. I think we've probably all been down that road. And the adjuster applied the factors based on the level of aflatoxin, and that reduced your production from 100 bushel per acre to 80 bushel per acre, okay? So the good news is if there's a payable loss in this scenario, you're going to get paid on the 80 bushel instead of the 100. So you get paid for that loss due to aflatoxin. The downside then, though, is for future guarantees, typically, you would be turning in this 80 bushel per acre yield into your database. And so what this quality loss adjustment allows you to do in that type of a scenario is you would use the 100 bushel per acre yield instead of the 80 when calculating future guarantees. So that's how it works. And like I said, we're generally recommending just adding this to policies. To be honest with you, I don't think in our area up here, we're going to see a lot of our historical yields that we have on the policy affected by this. I think the main year we ran into this was 2012, and that year is already excluded with the yield exclusion option for most of you. So then this really doesn't matter. It's not going to change your guarantee and it's not going to change your premium. But we are recommending adding it. And then if it comes into play in the future, if you know you had a quality loss issue, we can sit down if we need to and look at what the change in coverage is going to be and what the change in premium is going to be. But I don't think it's going to have a huge effect on us right off the bat. Preventive planning, there's a change this year for preventive planning qualification. To qualify for a preventive planning claim now, the acreage that's in question must have been planted to a crop, insured, and harvested in at least one out of the last 4 crop years. And harvested, it could also have been adjusted for claim purposes as long as it was not due to flood, excess moisture, or drought. So again, I don't think this is something that's going to become an issue in our area. For the most part, we probably do have some parts of the country that are maybe wet enough that this could eventually become an issue. But right now, I don't think we have anything to be too concerned about. I don't think this is going to affect anybody in here, but they did expand pretty significantly the counties in Kansas where you can insure double crop soybeans. So not really up into our region, pretty much Kansas River and south, but they did make a pretty big adjustment there. So another new option then for 2021 is this enhanced coverage option. You may have heard a little bit of talk about this. New available for 2021. What it does is it provides a county-based shallow loss coverage band. There are 2 different bands or coverage levels, you might call it, that are available. You can buy it where it covers from 86% to 90%, or from 86% up to 95%. So what that means, like 86 to 95%, is your payment is going to start to kick in at 95%, and at 86%, it is going to be maxed out. That's your max payment under the ECO program. It works very similar to SCO, which I'm going to talk about more when we get to the farm program section, but you've probably heard me talk about that some in the past when covering farm program stuff. The big difference with this, though, is that ECO is available regardless of which farm program you choose. It's not limited by any of that, whereas SCO is. ECO is subsidized 44%, so you're paying 56% of the total premium. And just for reference, because I am going to kind of touch on this later, SCO is subsidized 65%. So the SCO product is subsidized quite a bit more heavy than the ECO product is. So this, like I said, this is a county-based product. So the county yield at the end of the year is what's going to determine if there's a payment or not your own yields. The type of coverage that you get under ECO is going to match whatever your underlying policy is. So if you are carrying revenue protection, ECO is going to work just like revenue protection, but it's going to use that county yield to trigger payments to your own yields. You do have to add this on your policy by March 15th. And so here's some numbers. There's a lot of numbers here, but I'll kind of try to walk through this and explain a little bit of how this product's going to work. So I'm looking at an ECO example here with revenue protection. We get Ashton County, Kansas, corn. Choose an area loss trigger of 95%. So we're looking at that 95 to 86% coverage band, a 9% band. Using 460 for a projected price or base price. And your approved yield of 160 gives us an expected revenue for you of 736. We take that times the 9% coverage band to determine our coverage per acre. So the coverage provided under this is determined by your yield history, but the payments are triggered by the county yield. So in this scenario, ECO 95% would give you $66 an acre of coverage. The expected county yield for non-irrigated corn, Ashton County for 2021 is 151 bushels per acre. And so then the payment under ECO is just going to come down to what our harvest price ends up being and what the county yield ends up being. So if the harvest price is $4.60, same as the base price in this example, we have to get a county yield down at about 143 or 144 before ECO would start to trigger, with an expected county yield of 151. And then of course it pretty quickly maxes out and pays out the full 66. If the harvest price comes in lower, then the yield that we can have and still trigger a claim gets higher. So kind of, just like revenue protection, as that harvest price goes down, our trigger yield goes up. And then as the harvest price goes up, our trigger yield stays the same, but we can see our payment starts to go up a little bit more because we're going to get paid off that harvest price. So that kind of gives you an example of what the payouts under this product can look like in various scenarios. Okay, so then what about cost and what does this look like? So again, this is just an estimate looking at Atchison County corn. I'm going to zoom in here on a quote section of our coverage analyzer and focus in on this 75% example. Now, actually on ECO, the underlying coverage you're carrying doesn't affect the cost. It's going to be the same coverage band regardless. But we'll kind of look at this with 160 bushel approved yield. 75% coverage, revenue protection is going to give you 120 bushel yield guarantee, $547 worth of coverage. Enterprise unit coverage premium is going to be about $14 per acre. Optional unit coverage is going to be about $36 an acre. And then we move down here to the bottom and it shows our two options for ECO coverage. So the 90% ECO coverage in this scenario would give you about $29 an acre of coverage for $8 in premium. The 95% coverage band would give you about $66 in coverage for $20 in premium. So, as you can see, it is definitely not what you would consider to be cheap when compared to some of these premiums on your underlying policy. But this is a much higher trigger product that should trigger and pay out really a lot more often than a 75% coverage level. So should you buy ECO? And let me just start off by saying, like I have in the past with SCO and different things, and I'll get into this more when I get to the farm program section, it is subsidized pretty heavily, 44%. So what that means is that if you buy ECO, over time, you should expect it to pay you more in claims than you pay into it, okay? So theoretically, yes, you should buy it. That's easy for me to say, though, when I'm not the one that has to write the $20 per acre premium check on the years when it doesn't pay, okay? So, theoretically, that's true, but the answer is probably not quite that simple. So here's how I would kind of walk through this. Do you want more coverage? When you look at the coverage you're getting under revenue protection, do you feel comfortable with that, or do you feel like you need more coverage? If the answer is no, you feel perfectly fine with the coverage provided by your revenue protection policy, then I would say probably don't worry about ECO at all. I wouldn't mess with it. If you do want more coverage, though, then I think the first question is, are you eligible for SCO? Now, I'll get into this more in the farm program section, but of course that depends on which farm program you're in. If you're eligible for SCO, then probably consider it first, simply because it's a little bit lower coverage level, so that makes it cheaper, and then it's subsidized at a much higher percentage. So the cost is going to be much lower than ECO. But if you're not eligible for SCO, or you're purchasing SCO and you still want more coverage, then ECO might be a way to cost effectively add more coverage for you, as opposed to trying to increase your underlying coverage. And let me scroll back here real quick to this cost and kind of walk through that again real quick. Like I said, let's say you're at SCO, you'd like more coverage than 547. You have a lot of options to do that. You can obviously up your coverage. You could up it to 85%. You're going to pay an extra $28 in premium. and pick up $73 in coverage. You can add SCO if you're eligible. That's going to be about $11 an acre for $80 of coverage. That's going to cover from 86% to 75. And then there are these ECO options as well. So again, lots of different ways to get extra coverage. Kind of depends on how valuable you think county-based coverage is for probably a lower cost per dollar of coverage versus increasing your own underlying coverage. So. Okay, unrepaired levies. I'm going to skim through this super quick because I don't think this actually affects anyone that's on here. But just in case, so we're still dealing with some unrepaired levies from back in 2019. Any land affected by that in 2021, again, will be charged the highest rate possible in the county. Man, I can't quit yawning. Must be my bedtime. And we have seen quite a bit of change in this from last year. So it looks like on the Kansas side, a lot of levies got repaired and we're back to the old rates, less so on the Missouri side. So this is starting way up just south of White Cloud. Like I said, I don't think this affects anybody here, so I'm not going to dwell on this. This is just north of Atchison. Most of that is regular rate. We do have along Independence Creek and outside the levee there that is going to be triple B. South of town, that bottom area is triple B. Down to the county line, we've got some that is back to the regular triple A premium. Same with just north of Leavenworth and Leavenworth County, it's back to being triple A. And then on the Missouri side, we're still pretty much highest rate in the county. Southern Platte County, I guess, in this area, I think is back to what it used to be. But then north of that is still going to be the triple B, the highest rate in the county. And then Buchanan County across the bridge is still going to be triple C, highest rate in the county. So that's where that stands. All right, so as always, I'm going to go through also just how revenue protection works. So going into the season, I want to just give you a reminder of the coverage you have in place and how it works, and then specifically how it can work to help protect you as you look at doing some grain marketing this year. So we're going to look at a corn example with 160 bushel approved yield, a coverage level of 75%, and a base price of $4.50. And we're going to look at what happens if at the end of the year you have 120 bushel actual yield and our harvest price comes in at $4. So 120 bushels is basically your guaranteed yield, 160 times 75%. And then the harvest price drops by 50% between now and fall. Okay, so with revenue protection, we calculate the guaranteed revenue by taking your approved yield of 160, your coverage level of 75%, and the higher of the base or the harvest price. So in this case, the base price is the higher. We use $4.50. We get a per acre guaranteed revenue of $540. Then we have to calculate the harvested revenue at the end of the year. We're going to do that by taking your actual yield, in this example of 120, times the harvest price of $4. So our harvested revenue here is $480 per acre. To calculate your claim, we just subtract those two. And in this scenario, we get a $60 per acre claim. So this triggered a claim even though your yield was at your guaranteed yield. You really didn't have a yield loss, so to speak. But since the price fell, we ran into this revenue loss situation that triggered a claim. And then second scenario, we're going to kind of look at the opposite of that. We're going to look at if the harvest price goes from $4.50 to $5.50, so prices go up between now and fall. And what happens if you have an actual yield of 80 bushels per acre, so about half of what your expected crop was. So again, approved yield 160 times 75% coverage level. Now times the higher the base of the harvest price, though, we're going to use this harvest price of $5.50. So your guaranteed revenue basically increases to $6.60 an acre because that harvest price went up. Harvested revenue is going to be the actual yield of 80 times the $5.50 harvest price, or $440 per acre. Subtract those two out, and in this scenario, we get a claim of $220 per acre. Now, there is another way to calculate that number, really probably an easier way to calculate it, that leads me into talking about grain marketing. And that is that this $220 per acre claim is equal to 40 bushel per acre times 550. So what are those two numbers? Well, the 40 bushel per acre is your guaranteed yield of 120 minus your 80 bushels that you produced. You were 40 bushels short of your guaranteed yield. 550 is the harvest price. So what this means is that with revenue protection, anytime the harvest price is higher and you have a yield that is below your guaranteed yield, you're going to get paid the higher harvest price for each bushel you are short. That's how the product works. And that's what makes it work to help back up a marketing plan. So starting back at the beginning of this example, you're sitting here today, you've got 160 bushel approved yield, 75% coverage, base price is going to be about 450, right? Let's say sometime here in the next couple months, you get the opportunity to forward contract corn at $4.75 cash, all right? Now, you would probably never do this, but we're going to assume for this example that you got real crazy and you forward contracted your entire guarantee of 120 bushels per acre at $4.75. We get to harvest, and unfortunately, your actual yield was only 80 bushels per acre. And to make things worse, the cash price at harvest is now $5.25 a bushel, and our harvest price comes in at $5.50 per bushel. So you don't have enough bushels to deliver on this contract, and now the price is higher. So how is this going to play out? Obviously, you're going to take these 80 bushels that you raised, you're going to deliver them to the elevator for $4.75. You may be frustrated that you sold them at that price, but it is what it is. Pretty straightforward. What happens with the bushels that you are short on your contract? So we're going to look at that on a per bushel basis. So as I said before, what does insurance pay for each of those bushels? It's going to pay you the harvest price, right? So you're going to get paid by us $5.50 per bushel for each of those bushels. Now you're going to have to pay the elevator something to get out of this contract. Now that can vary a little bit by the elevator and by the language in your contract, okay? But typically the way this works, in this scenario, they would ask you to pay them 50 cents per bushel. And that is the difference between what you had contracted at and the cash price when you settle up. So you're gonna have to pay them the difference there to get out of that contract. You net those out, you got paid $5.50, you paid the elevator 50 cents, you still netted $5 per bushel on the bushels you didn't raise, which is essentially what you had contracted them at before. It's a little higher in this example because crop insurance pays off futures markets instead of cash. And so with a negative basis, you pick up the basis in this scenario. The gist of it is that even though you didn't raise those bushels, because you had revenue protection, you still netted out at the price you had tried to contract them at. So it really doesn't matter at that point if you raise them or not, you are still going to end up in the same place. Now, obviously with this, you cannot contract over your guaranteed bushels. Once you go in this scenario over 120 bushels per acre, you no longer have that coverage in place. So this product was designed exactly to be used in conjunction with the marketing plan. That's why it was developed. Basically guarantees that at the end of the year, you're either going to have the bushels or you're going to have the money to replace them at market prices. You do have to be more cautious prior to planting because if we have preventive planting claims, that coverage does not increase if the harvest price goes up. Preventive planting claims are going to be paid off the base price and that's it. So I don't think this means that you shouldn't contract anything necessarily prior to planting, but we do have to be a little more cautious. But then once that seed goes in the ground, you have this full coverage in place and you can safely contract, hedge with futures, whatever you want to do without that fear of a crop failure and not being able to buy out of that contract with the elevator or meet margin calls on a futures hedge. So again, just want to make sure you give you a reminder of that and some confidence as we enter the year. I mean, I had a conversation with a client yesterday on the phone talking about what's happened in the markets here over the last few months. And I think we see producers out there with a lot of uncertainty now because of this. You know, it's maybe you feel like you got burnt a little bit last year, and so it's hard to pull the trigger now. I would just encourage you, nobody knows where the markets are going. If they try to tell you they do, they're lying to you. So that's not what it's about. It's not about predicting the markets. It's about locking in profits. I think where prices are at now looks pretty good compared to where we've been. And so it's probably not a bad idea to start doing some pricing at these levels and hope that you're wrong. Hope that what you sell today is the cheapest grain you sell all year. You'd probably be in pretty good shape. So I just want you to know and have the confidence that that policy is there to back you up and hopefully give you the confidence to do that. So that finishes up the crop insurance portion. I guess let me just remind you, March 15th is the deadline to make changes on coverage. Obviously, we're going to be in touch with you to talk about your options and look at quotes and all that good stuff. But just keep in mind that that is the official deadline. And I think with that, I will dive into the Farm Bill overview. All right, so just a quick summary. We have this Ag Risk Coverage, or ARC program, that's an option. Within it, there are two options of county level or individual. So you'll hear me talk about ARC County or ARC Individual. And then the price loss coverage is the other farm program that's available that you have to choose between. Your farm program decisions on this are made by farm number and, by crop. So on farm number 123, corn, you can choose PLC, and on farm number 789, soybeans, you can choose ARC County. On a different one, different crop, you can choose ARC Individual. So that's made, except for actually ARC Individual. That is by farm number. So if you enroll a farm number in ARC Individual, all the crops on that farm number have to be enrolled in ARC Individual. So it's a little bit different. Any ARC or PLC payments due will not be received until about a year after harvest. I think you're well aware of this at this point. The program you choose by March 15th this year will only be in effect for the 2021 crop year. So last time we were making a decision like this, you were making it for 2019, which has already happened, and 2020, which is upcoming. This time it is only looking forward 1 year for 2021. And then also supplemental coverage option plays into this. This is not exactly a farm program. It's a crop insurance coverage that's available, but it's only available if the farm number and the crop are not enrolled in ARC. So because of that, it kind of factors into this decision potentially about what you want to do on farm programs. With under SCO, that crop insurance coverage payments get triggered by county yields, not your own yields. And remember, this is, I went through the ECO product and said it was similar to SCO. Obviously, SCO is also similar to ECO. SCO payments will also be delayed some, but they should be made in like April or May following harvest as soon as we have the county yield data. All payments for ARC County and PLC will be paid off of 85% of your base acres, not your planted acres on a farm. And then ARC Individual payments are going to be paid on 65% of your base acres, but it does get influenced by what you actually plant in that particular crop year. So it doesn't go directly off of planted acres, but let's say you plant 50 acres of corn and 50 acres of soybeans on a farm number. If you have 80 base acres, half of those base acres are going to be considered corn and half are going to be considered soybeans for the ARC Individual payments. That makes sense. SCO payments, however, are different. They will be paid off of your planted acres. So in situations where maybe you have quite a bit more planted acres than you do base acres on a farm, SCO might provide a little bit more coverage and more protection than these farm programs will. PLC payments also are going to use your program yields. If you remember at the beginning of this new farm bill, they allowed you to update your program yields again. So we turned in a bunch of yield history here 12 months ago, I believe. So that program yield is used to calculate your PLC payment. A couple quick disclaimers. You've heard me say this before, but anything I say in here is pretty general in nature. You have your own unique situation that may not exactly line up with what I talk about here. I use Jefferson County, Kansas examples for this. Other counties could have different situations. I think especially now that we're looking only forward and not backwards though, looking at one county and how it works is going to give you a pretty general idea of how these programs look for you as well. And this is the most important thing, especially now, is the best decision on this is not going to be known for about 2 years. We'll get into exactly why later. And that's going to depend on what grain prices and crop yields do in that time. And nobody can accurately predict those things, like I said. So it'd be great if we could, but what we can do is try to help you make an informed and educated decision. But that is in no way a guarantee that by the end of it, we're going to have chosen the program that pays the most. We're just going to try to make the best decision we can. So start by just comparing the programs and how they work. So to do that, first off, I want to talk about this marketing year average price. There's a marketing year average price that is calculated every year for each commodity. What it is it's a monthly cash grain price index for the 12 months following harvest of that crop. It gets weighted based on the actual percent of the crop that farmers sell in each of those months. So that varies from year to year based on selling patterns. It's relatively consistent over time, but you do see some differences in how much gets sold in each month each year. For corn, grain, sorghum, and soybeans, the time period that this is set is September to August. Now, keep in mind, talking about the 2021 crop, that means it's going to start this coming September in 2021 and not finish until August of 2022. So that's why I talked about, any attempt to try to predict what these prices are going to be right now is extremely challenging. As we've learned in the last few months, things can change quickly. On wheat, the time period for that is June to May. So again, for 2021, it will start calculating this June and finish calculating in May of 2022. So because of that delay, the most recent year that actually has them finalized is 2019. So this just shows you the calculation for the 2019 corn marketing year average price. It ended up being $3.56. You can see the average cash price received by farmers in each of those 12 months, the percent of the crop that got sold in each of those months, and you multiply all that out and add it together, and you get 356. So that's how those numbers are determined. Okay, so that's marketing your average price. Now we'll talk about price loss coverage, or PLC, and how it works. It is the simplest of all the programs. So with PLC, each crop has a statutory reference price. That just means a price per bushel that's written into the actual farm bill. It can also increase. I'm not going to focus on this much because for 2021, we know it's not going to be increased. We know what these prices are going to be. Payments for PLC get triggered whenever the marketing year average price falls below the reference price for the commodity. Okay, so it works very similar to a put option if you have any experience with that. Your reference price is like your strike price, but then it uses this marketing year average price to determine if it triggers a payment. So for 2021, these are our PLC reference prices: $3.70 on corn, $3.95 on milo, $8.40 on soybeans, and $5.50 on wheat. The payment under this program is going to be equal to that reference price that I just talked about. Subtract off whatever the marketing year average price ends up being, multiply that by your program yield that I talked about earlier, and then that would get multiplied by 85% of your base acres of the crop. So an example for corn in 2019, said the marketing average price came in at $3.56. So that was 14 cents per bushel below that reference price. So a 14 cent per bushel payment. This example, I used a program yield of 120 bushels per acre. Multiply those out, you get a $16.80 per acre payment multiplied by 85% of your base acres. So that's what PLC on corn looked like in 2019. Obviously, the higher your program yield, the higher your payment. The lower your program yield, the lower your payment. But that's how it works. The max payment gets reached once the marketing year average price falls below the loan rate for the commodity. Can't imagine this coming into play anytime soon because we are way, way above loan rates and have been for quite some time, thankfully. This just shows for each, for commodities, kind of at various price levels, and an example program yield, what that payment can look like. Really, the gist of this is just that in very low price scenarios, these PLC payments can get pretty large. And over the life of this program, we have seen some of that, especially on wheat and grain sorghum. So 2019 PLC results. So like we talked about, corn triggered a 14 cent per bushel PLC payment. Grain sorghum triggered a 61 cent per bushel PLC payment in 2019. It's pretty large. Soybeans, no PLC payment, but it did get relatively close to that 840 reference price in 19. And then wheat had a very large PLC payment in 2019 of 92 cents per bushel. So that's the most recent year we have finalized to kind of look back and see what happened. Here's a longer history going all the way back to 1989 of what those marketing year average prices have been on corn in each of those years. Here's your $3.70 reference price. So we'd say over the last 5 years, we've seen PLC payments triggered for corn. Now, this red dot is K-State's current projection for 2020 of $4.23. So they're projecting that for 2020, there will not be a PLC payment. And we're far enough into that it's probably not going to change dramatically, but still has some time to go. And then they are also projecting out to 2021 a marketing year average price of 405. Now, it is important to keep in mind that that is a price projection way, way out into the future. So a lot of things could change between now and then. I mean, look at some of the swings we've seen from year to year on marketing year average prices. So, wouldn't put a lot of stock in that, but that's the current projection. Would be no PLC payment on corn for 2021. Similar thing for grain sorghum. Like I said, we've seen some large PLC payments in the recent past with grain sorghum. 2020 projected to not have one. 2021 right now projected for grain sorghum prices to be lower, but still above that PLC reference price. Soybeans, like I mentioned, we have not triggered any PLC payments on soybeans since this program has existed. And right now, of course, bean prices are surging. And so for 2020, not projecting a payment, and 2021, not projecting a payment, and not projecting to be particularly close to a payment either. Again, a lot of time to go in that on the 2021 one, but that's the current projection that we have. On wheat, again, some pretty large PLC payments recently. K-State is still projecting a PLC payment for 2020. And then, and that price is, getting very close to final. But projecting wheat prices to get up above the reference price for 2021. So no PLC payments projected for 2021 there either. So kind of the gist of that is the way prices sit today, there would not be projected PLC payments on any of these four commodities, which I'm sure does not surprise anyone, and it is fantastic news. Okay, so now we will move on into Ark County. This one gets a little more complicated. This program is designed to provide protection against shallow losses at the county level. So a little higher trigger maybe than our crop insurance coverage typically is. It does provide some short-term protection against price declines because it uses a multi-year average to set the coverage price. Now the bad news in this is, in the situation we're in now, where we're coming off a few years of prices that are lower than they are today, this actually works against us, unfortunately. So we're going to be going into 2021 using prices that are quite a bit lower than the current market to establish the coverage on Ark County. So that's discouraging. The county yield history gets used to establish the guarantee as well. The county yield at the end of the season is what's used to calculate payments. In this program, some counties are going to separate irrigated from non-irrigated, but not all of them. I don't know if that has huge implications for any of you. I'd say if you have irrigation, that makes this product or this program a little bit less enticing in counties that do keep it separate. But I don't know that it's a huge issue. Under Ark County, we calculate the benchmark revenue or expected revenue, you might call it. To do that, we take a 5-year Olympic average of the previous county yields, multiply that by a 5-year Olympic average of the marketing year average prices. The 5 years that get used are going to exclude the most recent crop year. So for 2021, we're not using 2020 numbers, yields, or prices. We're using 2015 to 2019. Any marketing year average price in that time period that's below that PLC reference price, we're going to use the PLC reference price instead. And then there's also a plug yield for each crop and county that replaces really low yielding years. So once we have that benchmark revenue, we take that times 86% to get our guarantee. So 86% is kind of like our coverage level in Ark County. If we think about it in crop insurance terms, the actual revenue at the end of the year is just going to be the county yield times whatever the marketing year average price settles at. Your payment then is going to be the guarantee minus the actual revenue for the county with a max payment of 10% of whatever your benchmark revenue is. So again, works a lot like crop insurance, but at the county level, and then a max payment of 10% of benchmark revenue. So that's also very different than crop insurance. Okay, so here's an example of how this would look. So this is an actual example for Jefferson County non-irrigated corn. We can see what the county yields were in 2015 to 2019. The Olympic average of those is 140.2. All of the marketing year average prices were below the PLC reference price. So we're using the 370 reference price instead. So our base price essentially is going to be 370. We multiply those, we get a benchmark or expected revenue of $519 per acre. Take that times 86%, we get a guarantee of $446 an acre. And then our actual county revenue, like I said, is going to be the 2021 county yield times the 2021 marketing year average price. Payment is going to be the difference of those two, maxed out at $52 an acre, 10% of benchmark. So, said before, right now our projected marketing year average price for 2021 is $405. If that's what it ends up being, we're going to need a yield of county yield of about 110 or below to start to trigger an Ark County payment. So we kind of look back here at our county yield history. You know, we're going to need a yield that's one of the lowest of the last 5 years in order to trigger a payment. And have to get down to about 97 bushel per acre county yield to trigger a max Ark County payment. If prices go up, then we need an even lower yield to trigger a payment. If prices go down, we could trigger an Ark County payment with a higher county yield. But you can kind of see what those various scenarios look like. And at the bottom here, I put down what the PLC payment would be at each of these price levels, assuming that your program yield is equal to this 140.2, which may or may not be true, but for comparison, that's what we're going to use. So, you know, you can see we have to obviously get down below 370 to trigger a PLC payment. But if we do get down to, let's say, 345, $35 an acre payment, we'd need a 115 county yield or something lower than that to trigger an Ark County payment that was higher than PLC. So, but again, kind of the take-home message here is that assuming average or even decent yields and prices staying where they're at, Ark County payments are unlikely for 2021. That's just the reality of it, as well as PLC payments. So now this is the same information for grain sorghum. I'm not going to dwell on it much. I will talk a little bit more about soybeans. The main difference here is that we're a long ways from a PLC payment on soybeans, you know, way further than we are on corn, looking at current projections. So it's hard to get a PLC payment on this chart, whereas we certainly do see some Ark County payments. Still have to have some sort of a yield loss, but more likely than a PLC payment, I think. And on wheat, I said I'm not gonna focus in on that too much. Same basic concept as the other crops. So then real quickly, Ark Individual. Like I said earlier, if you do select this, it has to be on all crops that are on the farm number, not crop by crop. Also in that, for payment calculations, all the crops are going to be combined. So what that means is, let's say you have corn and beans planted on a farm number that is enrolled in Ark Individual, and the corn does really, really well and the beans do poorly. The good corn might outweigh the poor soybeans, and you end up with no payment even though your beans did bad, because the coverage is not just individually on the beans. We're combining all the crops together. And then if you select this on more than one farm number, they also get combined for payment calculation. So this is kind of like enterprise unit coverage on crop insurance. The more farm numbers you choose, the more get combined. And in theory, the less likely you would be to trigger a payment under ARC Individual. And payments are made on only 65% of base acres instead of 85% like PLC or ARC County. So that's probably the one thing that we haven't seen a lot of use of this program in the past. And that's the main reason why I'd say is you really start behind the 8 ball when you're getting paid on a lot fewer acres than you are the other programs. So it has a lot of ground to make up in that regard. The crops that you actually plant determine the weighted amount in calculating the benchmark revenue. Your 2015 to 2019 yield history on the farm is what's going to be used to calculate the guarantee. Your actual 2021 yields is what will be used to determine a payment. Your guarantee is going to be 86% of your benchmark or expected revenue. And the payment, like ARC County, is capped at 10% of benchmark revenue. So what might this look like? I just threw up an example here using corn. So looking at a farm number that is only going to be planted to corn for 2021, this is the yield history in each of those years from 2015 to 2019. Our Olympic average yield there then is 164 times 370 gives us a benchmark revenue of 607 times 86% gives us a guarantee of 522. So then the payment is going to be determined by what the final marketing your average price ends up being and what your actual yield on that farm number ends up being. So again, at 405, which is our current projected marketing your average price, you have to have a yield of 129 or lower to trigger a payment on ARC Individual before it'll start triggering payments. If the price goes down, obviously your trigger yield goes up. If the price goes up, your trigger yield goes down. Now, one thing you might notice here, the max payment for this should be $61 an acre, 10% of benchmark. I went ahead and adjusted these to account for being paid on fewer base acres. So these numbers that you see here would actually be paid on 85% of your base acres. So if you're looking at this and comparing it back to the ARC County slide, it's more apples to apples for you instead of trying to make that base acre adjustment in your head. And then you can see what a PLC payment might look like in those scenarios, assuming again that your program yield is equal to this Olympic average yield of 164. So really, again, just like ARC County with this program, it's going to take a yield loss or a significant decline in prices to trigger ARC Individual payments. Simple as that. But that's why you would have it, is to protect possibly against, specifically, I'd say, a yield loss on your own farm. Okay, so where might it be a good fit? I'd say FSNs that you have maybe where the yields don't correlate well with the county yield. So, maybe you have a farm that is flood prone in a county where there's not a lot of flood ground. And so something like ARC County is just not going to correlate with your experience at all. Maybe ARC Individual could be a good option. FSNs you have that have significantly higher yields than the county average. I mean, we see that some around here. I'd say this is more severe in some more marginal counties where the county as a whole, maybe expects to raise 120 bushel corn, but there's a few pieces of land here and there that are really good and are much higher. Having significantly higher yields gives you more dollars of coverage and helps you to make up for the fact that you're going to get paid on fewer base acres. So that's the importance of that. An FSN, excuse me, that's planted all to one crop works better for this. Simply not worried then about corns and beans canceling each other out, wheat, those kind of things. If it's all going to be planted to one crop, you can feel like that farm is going to have a consistent yield experience at least. I'm not going to dwell on this much, but maybe some FSNs that are currently in wheat, you can look out there and tell that it looks bad. Maybe feel like you have a little higher likelihood of payment on ARC Individual by actually looking at the crop. Obviously, on corn and beans, we have no idea at this point at all what the crops are going to be like. So that's some situations where you might consider ARC Individual going into 2021. I really don't see it as being a major fit for producers in this area, is my general take on it. So with that, and I will remind you, if you have any questions, please feel free to type them in or raise your hand and I can make it to where you can speak and ask questions. So don't hesitate to do that at all if you need to. But if I don't see anything, I will keep moving. So now I'm going to talk about supplemental coverage options. So like I said, this isn't really a farm program, but your eligibility for it is determined by your program decision. So it kind of gets pulled into this farm program conversation. Coverage is available if you're not enrolled in ARC, purchase it through your agent. We just add it onto your existing policy. March 15th is the deadline for spring crops. What SCO does is it provides coverage for you from 86% of your APH down to whatever your MPCI coverage level is. So it's kind of similar to Ark County in that regard, that the coverage level is 86%. The type of coverage that it provides is going to match your underlying MPCI coverage. So if you're buying revenue protection and you add SCO, it's going to work like revenue protection, meaning it's going to use the same base and harvest prices. And particularly in this year, I talked a little bit about one of the problems with Ark County right now is that we're using these prices from the previous 5 or 6 years to calculate our coverage, but our current market prices are significantly above those levels. Well, the good news with SCO is it's going to use the same, whatever base price we calculate here in February, which will be more reflective of market conditions. So that definitely gives it an advantage right now versus Ark County or Ark Individual. Your coverage will be on planted acres, not base acres. So that's probably a bit of a positive too, whether it's that we're going to make sure we get all of the acres covered instead of just the base acres. Also make sure that we have the right crop covered, as opposed to what the base acres are in, we're looking at the crop you actually plant this year. Premiums with SCO, I touched on this earlier, but are subsidized 65%. So you're only paying about a third of the total premium. And just as a reminder to kind of walk you through how that works and what that means, is when RMA builds a product like this, or any product, whether it be ECO, revenue protection, whatever, they build this program, and then they try to make an estimate of how much they expect it to pay out in claims over time. So let's say they build a product like SCO here, and they say, we expect that this coverage is going to pay out on average $20 per acre per year. What they do is they set the premium equal to that, so that premiums are equal to claims paid out over time. And then the subsidy gets applied. So you only pay 35% of that $20, $7 an acre premium for a product that expects to pay you $20 per acre per year, okay? There are additional admin fees if you add this, but just going back to this subsidy thing too real quick, kind of like I mentioned with ECO, this is the point that, you know, kind of the question of should you buy it? Well, in theory, yes, because if you buy it for the next 50 years, you're going to get paid more than you pay into it. But it's probably not quite that simple either. Another area where this is similar to Ark County is that it's going to use the county yield to determine if there's a payment triggered or not. So it's not coverage based on your own yield performance. It is coverage based on the county yield trigger. All counties for this program will use different yields for irrigated acres versus non-irrigated. Again, I would say that probably means that this is just not as attractive of an option on irrigated acres as non-irrigated. I think at the county level, it's going to be hard to pull an irrigated corn yield down enough to trigger a payment. And then to make that even worse, in some counties where there's not a lot of irrigation, they're going to go out into adjacent counties to get enough acres to determine a county yield. So you start stretching out into 5 or 6 counties on irrigated acres, and it's going to be pretty hard to get a yield pulled down enough to trigger a payment under this is my belief. Your crop insurance yield history and coverage does determine the coverage amount that this product gives you. So if you have a higher yield history, you're going to get more coverage than somebody who has lower yield history. If you purchase this, you do have to purchase on all the eligible acres of the crop in the county. So, you know, let's say that you've enrolled all your corn in PLC and you add SCO, we have to add SCO to all of your corn acres. However, if you decide to enroll some corn in Ark County and some in PLC, we can add SCO onto the acres that are eligible and leave it off of the ones that are not. But we do have to put it on all of the eligible acres. So here's kind of a graphic example of what this coverage looks like. So In these scenarios, each bar represents a different underlying revenue protection or MPCI coverage level. The green bar shows the amount of coverage provided by that underlying policy, and then the purple bar shows the SCO coverage provided. So as you can see, regardless of what coverage level you choose, when you add up your MPCI and your SCO coverage, they're always going to be the same. As you lower your MPCI coverage level, the SCO coverage expands down to fill that gap. And then down at the bottom just kind of shows the numbers of the dollars of coverage provided by each product, and then also some very rough estimates of premium. Obviously, when we provide you quotes, you'll have more specific quotes for you of what this product will cost. Loss examples, so the math gets really messy on this. I apologize in advance, but I'll try to simplify it as best as I can. In this example, I'm using 140 bushel APH on corn, a coverage level of 75%, base price of $4.50. We're going to assume that the harvest price comes in the same as the base price. I'm not going to get into playing around with that. We're also going to assume that the expected county yield is the same as your APH of 140. And then we're going to look at what happens if the actual county yield ends up being 112 bushel per acre, which is 80% of the expected county yield, okay? So what we do first is determine the maximum SCO payment amount or the dollars of coverage, depending on how you want to look at it. Do that by taking your APH times 86%, subtracting off your APH times your coverage level, which in this case is 75%, and then we multiply that times the higher of the base of the harvest price. And in this example, they're the same, so we use 140. We've got essentially SCO providing a coverage band of 15.4 bushels at $4.50 per bushel, about $69 an acre in coverage provided by SCO here. So all we're doing is trying to determine the dollars of coverage provided there, right? Now, to get the claim payment, this is where it gets real messy. We have to calculate this SCO payment factor. We do that by taking the actual county revenue divided by the expected county revenue, which in this case is 112 times 450, 504, divided by 140 times 450 of 630. Like I said before, that means our county revenue was 80% of expected. We subtract that off of our 86% coverage level. We get a 6 percentage point loss. We divide that by our 11% coverage band, and we get a payment factor of 0.545. To calculate the payment, we multiply those two numbers out. This scenario, you'd be looking at about a $38 per acre SCO payment. So like I said, the math gets kind of messy there, but really all we're doing is determining the dollars of coverage and then saying, okay, the actual county revenue came in at 80% of expected. How much coverage did you have above that? And that's what you're going to get paid. Okay. Okay, any questions on that real quick? And I'm going to refill my water here, and I'll be right back. And so if you have any questions, go ahead and type them in and raise your hand. All right, we'll keep rolling. So now actually trying to make the decision. So, you know, we're left with this decision between, do I want ARC, and then I can choose maybe between ARC County and ARC Individual, or do I want to enroll in PLC? And then if I do that, I'm eligible for SCO, and is that something I want to add? So let's kind of run through that. There's no perfect answer to that for sure right now, looking forward into 2021. Let's start by looking at short-term PLC projections. So for 2021, again, looking at K-State's projected marketing or average price for 2021 for each of these commodities. You can see all of them right now are projected to be above the reference price. So we're not projecting any PLC payments, but there is a difference in how much higher than the reference prices they are. Wheat's only about 5% above the reference price, corn and sorghum about 10%, and beans about 17%. You can already start to see now that, you know, probably wheat is the most likely to trigger a PLC payment at this point in time, with corn and sorghum following, and then beans least likely. But again, a reminder, the prices that are going to determine this are a long ways off. So these projections have a lot of variability left in them, but they're the best we have for now. ARC projections for 2021. So this is what the ARC base price is going to be. We know that going into the year. And then again, these are those projected marketing or average prices for 2021. What these numbers are is the percent of the expected county yield that would be required to start triggering an ARC payment. So essentially, if the marketing year average price for corn for 2021 ends up being $4.05, the county yield is going to have to be 79% of expected or less to trigger a payment. So we're going to have yield losses if prices stay this way to trigger an ARC County payment, or we're going to have to see prices drop. SCO. So again, is this a good option for you? And these are very rough numbers, but just kind of shows you if you're carrying 75% coverage, what that coverage might look like. And again, a very rough estimate of premium cost. When we send out quotes, you're going to have more specific numbers for your own operation to decide if that's something you want to look at. So, that's kind of trying to look at what might actually pay as best as we can. But then let's sort of step back and look at this more from a risk management perspective and think about what is your biggest unprotected risk going into the 2021 crop year. If you're worried about a county yield or revenue shortfall, so kind of a widespread drought type issue, then ARC County or SCO are the best options to protect against that concern. If you're most worried about your own yields coming in short, but maybe the county does well, then perhaps ARC individual is something to think about as a way to add more individual coverage on. Or are you most worried about grain prices falling from where they're at? If that's your biggest concern, I'd say PLC is probably going to provide the best protection against that specific risk. And as I've said maybe 100 times now already, for 2021, we're either going to have significant county yield losses or price declines for any of these programs to pay out in 2020. And then I've touched on this some, but I do think it's worth considering, especially this year, if SCO has more value than both PLC and ARC for that matter. It probably does in terms of being more likely to pay out, but you have to pay a premium for it. So therefore, it's not really an apples to apples comparison. So the deadline is March 15th. We're rapidly approaching that. I hope all of you have reached out to FSA and at least started this process. If not, do that tomorrow. If you make program elections or you already have, and for some reason you want to change them, you should still be able to do that up to March 15th. Kind of my summary thoughts, I guess, to boil this all down into one slide. On wheat and grain sorghum, I would still recommend PLC. Wheat prices aren't all that much above the reference prices. On grain sorghum, they're projected to be about the same as corn. But when I look back at that grain sorghum market, it is so volatile that I still think PLC is probably the best option there. We'll see what happens, but we've seen some huge PLC payments on grain sorghum over the past few years. And so I feel like that's much more likely to trigger PLC payment than corn. On corn, I really think it's a toss-up. You could flip a coin. You could think about which risk you're most concerned about and what you want to cover. On soybeans, I definitely lean towards ARC County just because we're a very long ways away from any PLC payments on beans, and we haven't seen it through the life of this program. So that leads me to think that it is also probably pretty unlikely for 2021. The other thing to think about, I'd say maybe especially on corn, is this an opportunity to sort of hedge your bets and enroll some farm numbers in ARC County and some farm numbers in PLC. And then if you do that, when we look at coverage quotes, you can decide if you want to consider using SCO. But maybe that way, if you do kind of a 50-50 thing, sort of, if we end up with some drought and the county yields are terrible, you're going to get some ARC County money. If we get significant price drops, PLC might kick in and pay for you. Hopefully, you don't get any payments because we had good yields and prices stayed high or moved higher. But not going to focus too much on those. ARC and SCO, it is worth mentioning, probably work better for counties with more highly variable yields. So, really, even if we were to compare Jackson County, let's say, to Donovan County, Jackson County yields are much more variable. And so ARC County or SCO is simply more likely to trigger a payment in Jackson County than it is in Donovan County. Now, on SCO, where there's a premium, it's also probably going to be cheaper in Donovan County when you look at it per dollar of coverage. But generally, that county-based program works better in a county that has more yield variability. Not going to even focus on making the decision or waiting because we're pretty much up against the deadline. So I think that's all I have. Yeah. So thank you all for joining us. We'll be in touch here over the next few weeks to get coverage finalized. If you have any questions, still feel free to type them in or raise your hand, or you can certainly reach out to your ag-risk agent. I'm sure you know how to get a hold of us if you have any specific questions that come along with this. So thank you. Wish we were in person. Wish we were at Jerry's again, but here we are. The good news is I really think even by late spring and summer personally that we are going to be back to something very, very close to normal. And that is exciting. I'm ready for it. Just these last few days of nicer weather. I don't know about you all, but it has changed my mood pretty drastically. So hopefully it stays this way. We have a good spring. Keep us posted as you do get into the field of what's going on. If you have any issues, hopefully not. Hopefully we don't hear from you all again until we finish planting and we're turning in acres. Nothing against you, but you don't want to hear from us either, right? So thank you for your time. Hopefully this was helpful. We'll be in touch and see you all soon. Thank you.